Welcome to this Killik Explains finance video. This week, let's look at 3 reasons for income investors to own shares. Now, a quick recap on the income you get from shares. It's called a dividend. And don't forget, if you buy a share in my mythical company, Tim plc, dividends are only part of the equation in terms of what you might get back. But they're the part of the equation we're going to focus on here. Not all companies pay dividends, some just offer capital growth, some offer a mixture of the two, and some offer, well, all offer voting rights, but other perks, discounts, and so on. We're going to focus on the top here. Now, don't forget, key facts about dividends. You don't decide how much dividend the company pays. All right, usually when they're called ordinary dividends, you're going to leave preference shares to one side. The directors sit down, work out how much of their annual profit they want to pay you as a dividend. That's then ratified by shareholders at the annual general meeting, but essentially you're not deciding on the level of dividend. And typically it's paid twice per year. In a few cases, quarterly, so you get an interim dividend, and then if the year's gone well, a top-up dividend called the final dividend once the accounts have been signed off and so on. So just be aware, the key fact from that slide is dividends can vary and they're not normally set by you as a shareholder. Come back to that later. Now, are dividend-paying stocks, if you've got the hang of dividends, a good bet? I'm going to look at 3 angles on this. So basically, yes is the answer. With the right approach, more about that later. Essentially, in a low yield world, and we are in a low yield world, bank interest rates are at record lows, shares are relatively generous. And I'll demonstrate that in a moment. Number 2, over time, long term that is, dividends have tended to rise, and that's important if you're looking at something as a source of income. And thirdly, if you're not drawing off income, reinvested dividends give a powerful boost to your overall return. More about each of these points coming up. So, in the quest for income, why would you look at shares? Because you could look at all sorts of things. You could look at property, you could look at government IOUs, corporate IOUs, cash. Where do shares fit in? Well, if you're looking for a half-decent yield, and when I say yield, I mean the total annual return as a percentage of the amount invested, if you like, shares come out reasonably well. So I've looked at a basket of broad shares. I could have looked at any basket. There's a FTSE all share, lots of shares in there, lots of UK companies, and if you look at this table, you've got an annual yield of about 3.55% when this snapshot was taken in April 2017. All right. Now, if you're thinking that's not desperately impressive, let's compare it to a few things. So investment grade corporate bonds, 2.6%, not bad, but well behind equities. 10-year government bonds, nice and safe, but a yield of around 1.5% when this snapshot was taken. And a typical fixed term deposit, locking your money up at the bank, for example, anywhere between 1 and 1.6%, but to get the top end of that range, you've got to take some risk in terms of the person taking your money from you. All right, so you can see that a basket of UK shares comes out pretty favourably in relative terms. In absolute terms, it's not punching the lights out, but in relative terms, looks reasonably attractive. So, next question is that going to grow? Now, I can't make a guarantee. The past is not a guarantee of future performance. We know that, to warn you about that. But with that in mind, this is a bit of a fiddly looking graph, but actually it paints a fairly sort of straightforward picture. This is the growth story so far. So again, taking that FTSE All Share Index from the start of the century, I could have gone back anywhere, but the start of the century up to roughly where we are now, let's say. Look at the picture. Now, if you're wondering, what is this picture actually showing? What it's trying to compare is the annual income, all right, that's the pink in pounds sterling, okay, from investing in the all-share index against the all-share index itself, which is this black line, all right? And what you can see is a broadly positive trend, and if you look carefully, you can see that at times, on occasion, where the index might have dipped, the level of income hasn't necessarily been dragged down with it. So if you're looking at this chart thinking, gosh, it's a lot of lines and pink shading and so on, what do I take away from it? Well, here's something you could take away from it in a snapshot. Key points. Look at the movement in the FTSE All Share from January 2000, that's the index, up to March 2017, and you get around a 23% capital-only gain. Compare in pounds the average value of a dividend from that index at the start and at the end, and you've seen it basically double approximately. So what message is that carrying? That's telling you that the rise in the index might have been relatively modest, although 23% is worth having, let's face it, but your income in pre-inflation terms, admittedly nominal terms, has risen quite a lot more dramatically. and it has risen over that period, and that's important. Now, the power of reinvestment. Let's say you're not relying on drawing off income every year. This is just taking a snapshot from a slightly different angle. Total returns matter, it says at the top. And the point we're trying to make here is, again, go back to the start of the century, whiz forward to now, and what you see, the black line, capital only, FTSE All-Share Basket again, is a 23%, well we said that before, increase in the index. On a total return basis, this is if the dividends are ploughed back into shares, reinvested as it were, you get a much more impressive gain in the overall index. So there's the power of reinvested dividend income. And don't forget, the companies that have to pay dividends tend to be quite disciplined, they tend to have to generate cash flow and so on, so there are practical organisational reasons for favouring dividend payers too. Now, the elephant in the room, it's not all plain sailing dividend investing, far from. So high yields can be a trap. There are no free lunches, and it's true when you're an income investor just as any other type of investor. So be careful, do your homework. Dividends can be cut or suspended. Companies the size of BP, Tesco and so on, people thought they could never cut their dividends, have done exactly that in the past. And that's something you need to watch out for. Realistically, diversification is therefore vital. Stock selection, portfolio building, diversification is key. Lots of ground covered there, quite a few busy charts. Any questions? Please email them to the usual place. And don't forget, our extensive library is available on this and other topics at killik.com/learn.